Founder and president of Japan NRG Platform and Yuri Group, Arnar Yazmussen, chief analyst and head of research at Global Risk Management, and Janiv Shah, VP Oil Markets at Rystad Energy. Thanks so much for joining us, gentlemen. Janiv, let me start with you. We have quite a few headlines this morning to look at on our bulletin. One of them is that oil is flat as weak demand, oil glut weighs on the market. Now, is that, in your interpretation, a headline reflecting today's market, or are they looking into 2026? All the commentary we've seen recently this week coming out of ADIPEC especially is, oh, well, we don't have a glut at the moment. And in fact, next year it's questionable because demand is uncertain, etc. And we have a spare capacity issue, possibly. Would you agree with that headline going forward? Are we going to continue to see that reflected? Oops.
First,
we lost? Oh, there we go.
Sorry, can you hear me okay?
I can hear you, and now I can see you again. Yes, great.
Lovely. Sorry for that. I'm not sure what happened.
Great.
Firstly, thank you. Good morning. I hear events at ADIPEC this week are fantastic, or nothing short of. So, shame we couldn't be there. Coming to the question, I think the market is reflecting something what we're seeing today, right? And going into the rest of Q4. Because as these days and weeks evolve, the market sentiment is becoming that much shorter and looking a lot more short term as opposed to what could happen. In terms of the oversupply, we do see that very much so right now, as well as going into Q1 next year because of the bearish fundamentals, right, on Brent. Firstly, supply growth from OPEC Plus and non-OPEC Plus is set to grow into Q4 and into Q1, depending on how the OPEC Plus meetings go moving forward. Non-OPEC growth, Guyana, Canada, and a few others are still increasing going into this quarter. And on the demand side, yes, there's weakness, obviously, because of the summer transport travel season that has firmly ended. But there is still some strength in some pockets. And let's be honest with the cracks for all three regions are still fairly supported. Margins from a refining perspective are still supported and are pretty much above where the seasonal averages are. But coming to the other points, mentioned some bearish fundamentals. We are, as you mentioned, somewhat bullish the rest of, so non-fundamentals, and that is a spare capacity challenge as well as geopolitical risk premium. So the oil on water, I think, coming to another topic to discuss here, is very much oversupplied, and the amount of volume on the water is significant, but a lot of that is non-tradable or that hasn't signaled a destination. So that's where another challenge comes from, where the numbers may be slightly masked.
Okay, that oil and water has not got to its destination or has not been pinpointed where it's going, but it's still there and it will get there, right? Arna, let's go to you with that. I mean, would you be as bearish as Janiv is in the sense that, this I've heard of sort of very short-term tightness. Obviously, we see that's doing to the curve at the moment. There's another headline that talks about OPEC's shrinking capacity, and that's supportive long-term for prices. I mean, what is long-term at the end of the day? But I mean, OPEC, there may be more oil coming next year. It might decide to do so, but for the time being, it's holding back in January. And why is that? Is that because it's getting nervous about the direction of oil prices in 2026?
Yeah. Good morning. Yeah, I think you nailed it there. Are they getting nervous, or is it because they feel that they're gonna support the market? I think the initial reaction was probably saying that, okay, OPEC is now moving back to a kind of, let's call it a price strategy. The market share strategy has been sort of abandoned for a while. But when you see this morning the OSP to Asia being dumped by the Saudis, you see Janiv mentioned
That's right.
200 million barrels a day. The 200 million barrels of oil at sea suddenly appearing in 8 weeks' time. We haven't seen anything like this since the pandemic. It is remarkable, and I've checked this with various companies tracking this, and they more or less have the same view. This is not just a flux. There is 200 million barrels out there more than there were 8 weeks ago. If we look into details, some is from the US, some is from the Saudis, some is from Russia that cannot find a home due to the sanctions. I think that's a part of the story. There's a big change going on here where buyers are switching, at least short term, from Russian oil towards US, Middle East oil, and it creates this this boom in oil at sea, but it is also a reflection there is an overproduction going on at the moment, and eventually this oil will find a home. If it finds a home in Chinese strategic reserves, I think the oil market is fine, and we're probably close to a low. But if this starts to show up in OECD inventories, maybe it was a small warning yesterday. We always have to be careful with the weekly data from the US, but they actually jumped, was it 5 or 6 million barrels? Could be a sort of incipient sign of this happening. If this is happening, I think it's a bearish sign. We say to our clients, if you're on the consumer side, maybe when we reach the 60 level, it is from a risk reward perspective quite a nice level to hedge, because I don't think OPEC will restart production again. This will hurt US production, and probably be a risk geopolitical sanction premium in the market. This is OFAC sanctions towards Rosneft and Lukoil. And yes, Russia are good in circumventing, but I think for the time being, they will have an issue finding a home for their crude oil.
Okay, interesting.
So yes, I share the bearish view, but I also see some supportive factor. We're probably not at the bottom left, but we are getting closer to that.
Yeah, and
$60 price. Yeah.
Yes.
$60 probably a relatively strong support level. It doesn't mean that we're gonna break through it, but it's a strong support level, because we saw OPEC reacted to it on Sunday and so on.
Yeah, and I mean, the other thing about the $60 is we had a couple of top traders yesterday saying that maybe the average for next year, which gives a bit of sort of swing above and below that price, I suppose. Of course, that being a lower average than we've seen this year, most likely, depending what happens between now and December. Yuri, good morning again. We have another headline about LNG freight rates surging by 50% as Europe looks to fill its sort of pre-winter gas, but not so unfavorable maybe for Asia, which has other options. I mean, I'm assuming that's LNG freight rates, a lot coming from the Atlantic, from the US. Asia, how would you say Japan and other countries in Asia are feeling about energy and LNG prices going forward as we approach winter? Are they well hedged? Is there as much nervousness as perhaps Europe might be feeling? You're on mute, Yuri. You politely stayed on mute, but yeah.
Thank you. Thank you for the reminder, and thank you for the having me on the show. I think, look, Japan has a very different approach to LNG procurement to Europe, and in most other energy markets, oil included. That is to say that around 85% of Japanese LNG volumes are procured long term, and in some cases, long term means 20-year contracts. So Japan looks at the market and has always looked at the market as the spot market, I should say, as a way to supplement volumes in terms of short needs, or to resell in terms of oversupply, or in times of oversupply. At this moment, obviously the dropping LNG and oil prices is a really good thing for Japan, because so much of the economy depends on minimizing the energy import costs, since about 80-90% of the primary energy of Japan is imported. We have Japan's import price, the price that Japan actually pays at the border, and is recorded in Japanese yen, is the lowest since just around February 2022, and just before that. So I think we're basically down to pre-Ukraine war levels. Even year on year, crude for Japan is down 10%. LNG prices are down just under 9%. And this isn't just good in terms of sort of today, the picture of the hour, but I think, if Japan is going to be one way or another strong-armed into signing long-term LNG contracts for Alaska LNG, for example, if as it is continuing to sign, as Japanese companies continue to sign more LNG contracts from the US, even outside of Alaska LNG, certainly having a lower price at this moment is probably going to be beneficial for negotiations. But yes, overall,
even though we have a big supply, I mean, obviously medium to long term, a lot more LNG coming on online, don't we, in terms of supply? So could Japan be thinking, well, maybe I'll wait a bit longer? I mean, to negotiate these long-term contracts. We have a shortage today in terms of the spot market, but in terms of Japan, which buys mostly term, with all the extra LNG that's coming on 26, 27, does it feel very comfortable? I mean, basically even more comfortable than you're saying it's in a position at the moment.
Well, I think there is certainly some of that, and at this moment, none of the letters of intent for Alaska LNG, for example, are anything more than sort of a piece of paper saying we're interested. Some of the contracts signed with U.S. LNG suppliers in the Gulf have been confirmed, though. I think that the reality is that, one, Japan still values security of supply as the number one priority. Cost sensitivity is incredibly high compared to the past for Japan. So therefore, yes, it is a lot more concerned about the direction of prices and so forth. But given the expiration, for example, the expiration of the Russian LNG contracts from next year over the next 5 years, and I don't really think that Japan will, but if Japan were to, for example, forego some of those renewals and see contracts elsewhere, or look for replacement volumes, or just additional volumes in other countries and destinations, it's all about which year the deliveries can begin, and therefore you only have a finite amount of negotiation room because you kind of have to lock in the dates.
Okay. Thanks, Yuri. Jeanive, back to oil. You were mentioning, you had touched on refinery margins, etc. Just to touch on the Russian equation, because with the recent sort of, I suppose the OFAC sanctions is one thing, and then you've got the physical attacks on some of the refineries in Russia that have had a bit of an impact, and that has sent more crude into the market because it can't be refined domestically. Are you feeling that in the statistics that you see? And will that help to, I suppose, counteract any sort of bullish sentiment that the sanctions may provide in the immediate term?
Firstly, I think it's fairly balanced, right, between the fundamentals and non-fundamentals within the market and what's weighing or supporting the prices. When it comes to Russia, yes, the attacks over the weekend, North Sea refinery, Tuapse refinery, and Tuapse port were also attacked. But these are typically in the recent trend of attacks have been on export-based refineries. So refineries that are exporting products, diesel, gasoline, naphtha, fuel oil into the market. And the challenge there is, yes, as more get attacked, and we do see that number potentially increasing as a Ukraine revenue hit on Russia, combined with this OFAC sanction discussion. But as that increases, yes, there is an increased potential of crude export into the market. Now, if it's only refineries that are hit, that's, I guess, the argument there. But if their ports are also hit, then there's also an infrastructure risk that exports may not be able to be suitable or viable for the market, which means that at some point in the next couple of months, storage levels within the Russian system for the crude side on land and on water could reach maximum levels, and after that we can see some production shut-ins. So yes, there is it's a bit of a domino effect, and that could lead to potential reduced Russian revenues. But that reduced Russian volume onto the market could, and I'll say this with an asterisk, open the door for an OPEC Plus decision in the next couple of months for an unwinding. So the same way that they've mentioned that there's a pause, there could be another reversal. Obviously, eyes on Russia, and depending on what happens within that system.
And of course, if that were to happen again, it's back to Saudi and a couple of those members to bring on that immediate supply. Anyway, Arna, I want you to help explain one headline that's on our bulletin today, that the Fed has no room except to expand its balance sheet by another 500%. And that's a bit more complex than just, I believe, just increasing the money supply. They're talking about the sort of the balance sheet with the interbank, sort of, I suppose, how that might affect interbank rates, etc. But tell us, on the whole, if that's something that you see is, that's going to happen, impact, for example, on the dollar, and what that means for oil, if anything. I mean, it's a big question, I know, very broad, but Fed policy as we go into 2026, Trump's had his way so far. How's the oil market looking at that, if any?
I think you can say, if you actually do what they talk about in this article, you will of course add a lot of dollar liquidity into the market. That will be a weaker dollar, that would be, and in that way, it could be positive for oil prices. It could also, you can say support the U.S. economy, but of course comes with the caveat that this could also mean more inflation in the US.
And what is the pulse in the US at the moment with that, with the inflationary sort of sentiment?
I think, to be honest, I think it's rate cuts. Normally, you will only start expanding the balance sheet when you're sort of maxed out on rate cuts, basically hitting the lower bound at zero. There can be some that you need some dollar liquidity, and if they're going to issue a lot of bonds and so on, it becomes quite technical here. But I think from an overall view, it's more important whether they're going to cut rates or not. I don't think they have any plans to sort of aggressively expand the balance sheet, even if this Trump Miran gets to head the Fed, the one who wants to cut rates basically to zero or tomorrow or whatever. So I don't put too much focus on that in my view. But of course, lower interest rates, weaker dollar is on the margin positive for especially if it's in a situation where the economy doesn't really needs it. You can say, what about the U.S. economy? Does it need lower interest rates? I think that the labor market has certainly stalled. We're not completely sure because of the lockdown. We don't have the labor market reports, but the ADP report sort of indicate it's not a catastrophe, but it's just it seems like employment growth has come to a more or less stand still. But inflation is of course still an issue. But I think the big thing for the market is now it actually seems like it's not unlikely anymore that Trump could lose this what's called trial or in the Supreme
Court ruling, yes.
Against a lot of the tariffs. And if they do that, that would mean that tariffs will be off. Many of them, not the one on aluminium, for example, or steel or autos, they are under different rules. But it will also mean that a lot of companies could ask for a refund. That would be a nightmare for the Treasury because they have to pay out a lot of money. There'll be no incoming, and we give a boost to the economy. So that's quite something to follow. And I think it came on the agenda. We saw interest rates moving higher in the US yesterday. Not a massive move, but I think there's a concern there that this debt issue will suddenly return with a vengeance to the market. But so far, the market is taking this quite calm.
Yeah, it certainly feels like it's time for this tariff scenario to start, clarifying and consolidating. I think countries are probably losing patience, and if it's beginning to turn against Trump, maybe then he'll also provides a bit more clarity to that. Well, there's our survey question for today, which addresses that. What impact would that decision by the Supreme Court, if it does derail his tariffs and the right to do what he's doing with tariffs, what impact would that have on oil markets? Would it be bullish, bearish, or have little impact?
I think it's very much has to do with how risk appetite reacts to this. On the one hand side, you pump a lot of money back into the economy, you remove tariffs, that should be positive. But on the other hand, this would create so much uncertainty that I think the reaction would just be to push the sell button, to be honest.
Okay. Well, that's something that the market is sort of waiting for. Yuri, let's talk a bit about the Japanese economy. Since we last had you on the show, I believe you've got a new prime minister who nominated Donald Trump for the Nobel Peace Prize. So I already don't like her. But anyway, very impressive lady otherwise, I'm sure. And certainly gave an extra boost to the Japanese stock market that was already doing well this year. Give us your take on the sentiment as the year ends on Japan's economy, stock market as well. What's providing that positive sentiment, do you think, and turnaround? You're on mute again. Yeah.
Sorry about that. So I think, first of all, I will come to the Peace Prize, right? Nominations. I think it's important. The context is really important.
Yeah, I mean, he did that while he was, obviously on the visit of the president for the trade negotiations. Yeah,
exactly. So the issue here is, and this really ties in with the economy, is that Japan has been somewhat in limbo over, well, pretty much the last 12 months. It had for a very long time, it had a majority government ruled by the LDP and a coalition government, and that was basically able to push forward government policy and so on. And then about a year ago, you had a prime minister elected in a minority government And he basically had to make a lot of concessions to opposition parties. What this means is there were a lot more problems with getting the budgets passed, and certainly he was in a much more constrained position in terms of negotiations, including with the US, and being able to make sure that, you know, the negotiations with the US actually resulted in something he could, let's say, sell back home. So as it happens, you know, Japan had negotiated, I don't know, acquiesced to this sort of imperial tribute of $550 billion supposed investment that Japanese either companies or financial institutions have to provide or guarantee to the US for infrastructure development within the US. Now, the reason I mention this deal is because this deal is essentially the reason that the tariff rates for Japan, which were initially set at 25%, were reduced to 15%. All of this happened under the previous prime minister. And then basically because of the turmoil of the re-election of the leadership, etc., Prime Minister Takaichi came in towards the very end of October. She was finally had to push through, had to ditch the former coalition partner, had to find a new coalition partner, and finally get sworn in as the prime minister. Lo and behold, within sort of 6 or 7 days of her even coming into office, taking the first official photographs and so on, and nominating her cabinet, Donald Trump arrives.
Yeah.
And suddenly you have to not only, you know, sort of keep up with all the agreements that were made under the previous administration, you have to make sure that he obviously has a good time, he feels confident, feels happy. And as her mentor, the former and the late Prime Minister Abe, who, you know, Donald Trump counts as one of his friends, so he says, as her mentor showed, that basically one of the best ways to do Trump diplomacy is through quite a little bit of, let's say, extremely kind words and positive statements. So I think that, you know, the Prime Minister of Japan, whether she really will nominate him for a peace prize, that's not really, you know, particularly
Yeah, she's playing the game, playing to his ego,
she's playing
and that
a
works.
game. She's been in office 6 days. She suddenly comes in, you know, she's meeting the head of the #1 defense guarantor for Japan. You know, and it has to work out. So I think under the circumstances, most people applaud the fact that she pulled it off, that it was a really smooth visit, and that Donald Trump, you know, left saying, you know, I'm very confident in Takaichi and I would like to work with her. So that's a really big positive. Now, the economy itself has also been in a somewhat okay state. I think like steady is the best word to describe the Japanese economy. But looking forward, you know, what the new prime minister faces is some of the things that Arne was talking about in the US, inflation. So one of the first things that she has to tackle and has already tackled is to say, we need to look for quick wins to bring down the cost of living. So one of the first things that she's done is agreed with the opposition parties to repeal a gasoline tax and a tax on diesel, right? This is a measure that will lower the price of the pump, if you like. So it's a small step, but an important one that sort of builds on her popularity and government. But going forward, if you look sort of the longer term, because Japan has agreed these sort of, again, very, very little detail what these investment deals are about, but essentially it's sort of financing a lot of the infrastructure build out in the US. Now, on the plus side, that gives potentially an in for quite a few major Japanese infrastructure vendors, power, equipment suppliers, nuclear vendors, and so on, you know, supposedly preferential treatment in some of these big nuclear projects, power data center projects, etc. in the US. But on the other hand, it also seems to imply that Japan has to provide an enormous amount of financing into the US economy at very, very unfavorable returns in terms of what we know of the deal. So I think that,
but returns in another way, probably on the trade front and other sort of reciprocal, I suppose, favors from the US. Yeah, thanks, Yuri. I mean, thank you for that. And it's great to get that sort of a perspective from Japan, which we don't often get. Thank you. Janive, I mean, sticking to Asia. I mean, Arne mentioned China earlier. And, will it continue to take in support with its inventory buying? A lot of chat about that these days. It has been a significant player in kind of keeping the oil price where it is the last few weeks, at least. And we had this new sort of 5-year economic plan, which headlines on China are looking suddenly a bit more positive, right? And how will that filter through to demand? We have two in our bulletin today. One is about its EV challenging German brands, and the other one is about, NVIDIA's chief saying China's going to win the AI race if the US isn't careful and doesn't loosen up a little bit. So China economy support for oil going forward, is that looking, do you think, more positive going forward than we would have said perhaps 3 months ago?
I would tend to agree with that statement, Diallo. Part of the reason here is, yes, there is a growing sentiment towards non-oil, right, towards renewables for the longer term, as what we've been reading and seeing and hearing. But I think on the ground, refinery runs are going to drop every month going into until the end of the year. But there is still some diesel resurgence that could pop up going into December and maybe even to January, right? So that support definitely is available should it materialize. Coming to the other part here, discussing China has always been historically, presently, and in the future, the beating heart of the oil market. And, the rate of electric vehicle penetration or adoption rates is something that can threaten the oil part of within the system, but it can also support it to a different extent. Now, we mentioned the Chinese stockpiling as Arne mentioned, right? So we do see some slowing rates going into the back end of this year and going into next year. But part of the reason there is because, of course, sanctioned barrels are the ones on the menu, have historically been the ones on the menu. But of course, with the sanctions and not just on Russian volumes, but also on Chinese entities, that could be challenged. And the other element to discuss there very quickly, I know we're running out of time, is with that independence. Those are the independents who typically took those within China, and they are reducing in firstly volume, stature, size, etc., with the large mega independents that are coming in and taking more market share. So yes, we do see China being pretty much at the forefront of things moving forward, but the swing factor within the system is definitely up for grabs, and that's multi-regional based.
Okay. Arne, just going back to you, let's take a broader look on other commodities. And I mean, let's include gold there in terms of what it's been doing as a hedge against sort of the uncertainty we're seeing, a weakening dollar, etc. But also other soft metals, perhaps. And again, what economies like China are doing to influence that. Where would you see we're going to that? That's all looking quite bullish, isn't it?
Yeah, I think like copper is of course the sort of the big bet on electrification across the globe, and I guess it's a pretty certain bet that is going on. It's just a matter of how much supply. Rare earth metals is of course the talk of the town. It'll probably be for the coming years here in Europe. In relation to energy, we actually focus quite a bit on the carbon price. You can call that a commodity if you like. It has actually been rallying quite a bit over the last 2 months. That's going to be a relatively tight market next year. Gold seems to have sort of stalled around this 4,000 level, but it's hard to see that the diversification away from U.S. treasuries and that's going to continue, and it's probably just a pause before we start moving higher again. Yeah, it's not an investment recommendation from my point of view, but it seems to be the overall theme that down the road we will eventually have a weaker dollar. Central banks are diversification, especially I guess in China, Asia. They saw what happened to Russian FX reserves, so it makes sense, and it is a big wave. It's not going to stop tomorrow, but it's going to be a volatile market. We also seen in Bitcoin, for example, one day 120,000, and then 2 days later or whatever, we were below 100,000. Volatility in some of these investment vehicles can be pretty high from time to time. It's not going to be a one-way street higher. I think that's important. And also, it seems like the dollar has actually regained some strength.
It did recently, didn't it? Yeah.
Lately, Fed is maybe not gonna cut rates as aggressively. Other countries are cutting rates. We see when U.S. equities from time to time come under pressure, we see these so-called rebalancing flows, because the U.S. market is so much bigger than all other markets that if Nvidia drops 5%, all investors abroad suddenly have a too high dollar exposure, and then they're selling dollars in the forward market. It's a bit technical, but it seems like that the dollar weakness is also not going to be a one-way street.
Okay, great. Well, thank you, Arne, for that, and Yaniv and Yuri for joining us today. There's the results so far of our poll. No one is bearish about that, so bullish or little impact, and we'll see how that develops over the day. Thank you so much, gentlemen, for joining us today, and have a good day and weekend ahead as well. All the best.
Thank you.
Thank you.